we have Sam Lessin here in the studio. Welcome to the show, Sam. How you doing?
I'm doing great. How are you guys doing?
We're doing fantastic. We just had a fantastic conversation with Carol Hausman and Lockie Groom over at Physical Intelligence. Did you see the demo of their cleaner robot, the Roomba?
No, I love
5.0?
Lockie. I haven't seen him in a bit. I know is this the folding robot?
It can fold your laundry.
They've been folding shit in like a warehouse for a while.
Yep. Well, they're doing it in the real world now. The demo was they sent the robot out into the field. It cleans someone's house. They say it's about 50% accurate. They're getting ready to deploy it once it gets to 99% accurate.
What does a 50% accurate cleaning robot do? Like,
I would
half the
imagine
time?
Yeah, it can fold half of your shirts properly and half of your shirts improperly.
Look, in fairness, that's probably better than I could do. I'm not much of a folder myself.
I'm terrible at it. I'm terrible at it. So, anything.
I would be a terrible laundry robot personally.
Yes.
Great to see you, Sam.
Always fun. You guys are crushing it. I'm loving the vibe. You're both full time now.
We
like
are
you've got
full time.
ads.
Yeah, ads. Yeah, we can do some ads
never
right now.
side hustle.
Yeah,
that's our never side hustle.
hustle.
Always full hustle.
Yeah.
What's going on in your world?
I don't know. I've been traveling a bunch, but I'm back. And
traveling
back
as a venture capitalist? How does that work?
Oh, just for fun, guys, not for work, please.
Yeah.
No, I just.
But I would imagine such a prestigious career path is so demanding that you would never be able to take a day off.
Never. No, I am a slave to Zoom. I just sit here and Zoom back to back.
You seem to have cracked the code.
What's your stance on Zoom? Do you invest much purely over Zoom, or are you just meeting everybody at this point?
It's a really interesting question. I personally think Zoom's had like a really interesting impact, I think, on venture capital. Because initially people were all bowled up on how Zoom and this like no meetings in person was going to open the funnel, and people would like invest all over the country, and we break down walls because all of a sudden physicality, and like there was like this kind of euphoric Zoom will be democratizing type thing going on. And it's interesting. I do think that Zoom means that people like me and venture capitalists are willing to take more meetings than we otherwise would be on like interesting topics with people that like, again, like it's just like the barrier is lower. You'll meet with more people. Now, does that actually result in more investments? Unclear. I think it might invest in like broader sets of first meetings. Just because the barrier is lower, and like if the meeting gets boring after 15 minutes, I can just do my email and say right? So like it's like there's some breakdown in like access, but it's not clear to me how much that resolves to like actually broader access means. And in fact, I think that's one of the big things that's interesting about AI broadly right now is, there's this narrative like with auto scripting. I get the number of pitches I get that are like half written by AI or written by AI is like out of control, right? I don't know what people think they're doing with those because they're all just going to get deleted, right? And if anything, the irony is the fact that the barrier now is so low to those emails means that even the ones that actually are legitimate just get archived because like on the margin, they're probably spam. And so there's this interesting thing where AI is actually making venture capital, I would argue, more insular, right, than it was before, not less insular. Right. So there's all these like unintended consequences going on of Zoom, of AI, of all this type of stuff in VC.
Yeah. Email, you just got to use it like text messaging. Just no subject, no body at all. Just whatever you have to say, just put it in the subject and send.
Look, I actually am I'm old. I'm like 41, right? So I'm like I love email. Like I think it's great. And I'm an inbox zero guy. But I also like run aggressive filters on my email and like am fine not responding. Like I don't consider email a contract that because you sent me something, I'm required to send you something back. I think you just have to treat it differently.
What about on text? Are you an inbox zero on text?
Text I take pretty seriously, actually. So that is like, I kind of have a pretty quick SLA on text, and I try to make sure that not everyone knows my actual phone number.
Let's put Sam's phone number up on the screen for everyone, so you can text him if you have.
Force me to get another. Well, I'll give you my plug, which is one of our companies is called Open Phone, which is a great company.
That's right.
And that I use an Open Phone number for a lot of things where you want to put it up on screen, and it's great. It's like a second text inbox. That's not really the purpose of the company. It's more sophisticated than that, but I like it for that.
That's great.
We should set an open phone lineup.
We should.
For me, I like to think of the hierarchy of like inboxes, right? Email, But then now it's like, okay, you have XDMs, iMessage, WhatsApp, Signal.
If you want to get in touch with me, show up
it's
and
basically
grab me
like,
by the collar.
Yeah, it's basically
shake
like
me until I
juggling.
hear what you have to
Well,
say. That's the
it's
only
interesting.
option.
I mean, so I have like my stack is text is incredibly important and serious. That's like a 1 hour SLA, but it's limited.
Yeah.
Email I take very seriously. Like I really care about email. But then people are like, you should be in my Discord server or like Slack. I'm like, absolutely not. Like I think those things are disasters. I refuse to engage with them. I hate everything about them, despite the fact Slow was one of the seed investors in Slack, and so I have to thank Stuart for making us some money. But like, I just like can't deal. I refuse to deal.
Yeah.
Let's
take us through the.
Should we talk
report.
about venture capital? I actually want to start and go back to your 2023 piece,
Sure.
which is on the timeline. You called out, this is October 16th, 2023, the shutdown of the VC factory line and the death of the factory farm unicorn narrative, the awkward crowd into seed investing by multi-stage firms, the mirage of AI and LLM startup investing, the post-pandemic fundamental cultural change impacting startups. Which one of those?
Yourself?
Yeah, how would you grade your predictions?
I obviously grade myself excellently on all of them. No, I mean, I think like, look, I try to pull up every few years and just, especially in times of uncertainty, just be like, what is going on? Like, where should we be spending time and our attention? I think, 2 years ago, those were the big themes for me. Is one, we were very used to for 10 years as a fund, effectively operating on this factory line. We take in companies at a certain stage. We know what metrics they have to hit. We give them the money. We then package them and send them on to our friends at Series A, who then send them on to B, and da-da-da-da. And the whole thing works beautifully because at the end, we pop them out into the public markets and retail investors buy them and life is good. And I was just saying, like, after the pandemic, people wanted that to come back. And I was like, this is not coming back. Like, the market it's a mixed up market. We've basically produced a bunch of these things which are on paper unicorns, but like they're not fundamentally important businesses. And more importantly, there's been this huge release, which is the biggest platforms in the world can just keep getting bigger. Like I remember a time when like $100 billion company was a huge company, right? People thought there was a limit to how big the biggest could get. And so there was this constant hunger in the public market for what's the next $3 billion company that's going to grow really fast. And there was coverage for that. People cared about it. And now the obvious answer is just like put more money into Amazon, put more money into Meta. Like there is no upper bound. And so I just think the markets have shifted, demand from consumers has shifted at the public has kind of rippled back to the ecosystem. What we have now, and I have this in the 2025 version, is what I'm calling zombie corns, right? So there's all, friends of mine were like, oh, we're going to see this mass extinction of these unicorns. They're all going to die because, they're going to run out of money. No one's going to fund them. The liquidation preferences are huge. They can't go public. They actually mostly didn't die, right? What they did do is they basically sacrificed growth. They cut their burn a lot. They kind of got marginally profitable. They can kind of exist. And they're kind of zombies. They're out there. They're not going anywhere, but they're also not going public. There's no market for them. No one knows how to buy them. The liquidation preferences are set up so that no one wants to deal with them, and they're just going to kind of exist.
Well, so the factory line is broken at the late stage because there's no off ramp. But in many ways, the sort of early stage pre-seed to seed to Series A is still accelerating as though there's an off ramp. Right?
I don't think it is actually. I think this is like the part of the 2025 deck or trying to think about what's going on. I actually think what we now have, weirdly, is effectively several markets for companies that are pretty decoupled from each other and kind of have their own logic and exist in their own vacuums. So like there is a public market, like the public market exists, it's the biggest, right? There is a private market now. There are companies that are private and will like probably never go public or never for various reasons. The way that companies are valued by the late stage private and the public market are actually just different. Like what's valued is different. How people think about them is different. Large LPs actually invest in both, so they don't care. But there's basically like running two parallel universes that don't have a lot of operability. Now, at the early stage, I actually think the same thing is going on, right? Which is like there is a kind of seed to pre-seed-esque market that exists, and people compete and people get excited, and there's kind of a market clearing price for startups and invest. Sure, but then when you say, well, what does it take to hop from an early stage, call it like pre-seed, seed, maybe sneaking into A, to like a legitimate B and beyond growth round, there's no more like magic numbers you hit and like a valuation framework that's consistent. It's actually much more about belief. You know, I say in the deck, it's a lot about this kind of new math of people want downside protection and then an option on infinity, right? And so like, what's the average of infinity and zero? It's infinity, right? And so the way people are backing into valuation, so the entire factory is predicated on $1 million in ARR equals Series A at price blah blah, with 30% growth and $10 million in ARR, like triple, double, double. You can come up with all these frameworks. Everyone kind of agreed on shit, and there was just like market clearing action and prices. And now I actually think there's just like distinct markets of belief that are really hard to move between.
Well, does this necessitate like a different model around growth? We kind of saw this with the crossover investors like Tiger, but a lot of growth funds have this downside protection mandate, no zeros, but let's underwrite to a 3x. And yes, I mean, I hear your infinity thing. That does happen every once in a while, but I think in general, a lot of growth investors are just saying no zeros and let's triple our money over this deal. But should you have more later stage growth investors that are thinking more like portfolio construction at the seed stage?
I think that the answer to that basically is I don't even know when they talk about we're underwriting to a 3x, who's buying, right? Like everything is about the marginal buyer, right? There is no value on anything, right? It's all about who's going to
like a DCF. I mean, you could justify the cash flows, right? You could comp to the public market.
The problem with first of all, comping to the basically nothing at late stage is trading comp to the public market, really, right? And we can get into like why and how. I think that look, the DCF comp to the public market, that is the factory model, right? It's basically saying like, hey, I have a late stage thing, I put money in, it's gonna triple, the DCF looks like this, it has this much profit margin, like this is the story, package sell to the public market buys on that same story. Like that was the mentality that persisted for a long time, and it was a great system for money making for a lot of people, right? I actually think that again, the public market now is like, well, if I kind of just want those types of metrics, why don't I just buy more of the Mag 7? Like I don't even want to dick around with your subscale offering. Like I don't care, right? Like I think, and there's reasons for that. It's because the big LPs are bigger. It's because of meme stocks. Like there's a whole bunch of stuff going on there, right? That like kind of makes that happen. But the net outcome is there is no off ramp to the whole. So then the question is, when you're underwriting at a late stage, you also have to underwrite to someone buying from you, right? And like the question is, what are they buying and why are they buying it, right? And I think this is where it gets a little bit squirrely, because I do think, I'm not the only one saying this, but like private to private transactions are going to happen way more, right? Like you're going to look just as it happened in private equity, funds will sell to funds. Then the question is, well, what is the buying fund paying, right? They're going to pay, they need some margin. They need to have a framework in their heads about how they're going to sell, right? So then you're going to be paying, you as an early stage fund are no longer underwriting to some late stage, to some DCF, to the public market. You're really underwriting to who's going to buy from you. What's their narrative on buying? Like, why do they want to hold this, right? Like, what's their time horizon? What's their purpose? And like the irony of the whole thing is like, honestly, those prices are going to probably be much lower than what the DCF might otherwise imply, right?
How do you think about funds, selling an entire fund? And I'm talking about venture funds, maybe selling to other, kind of like not continuation vehicles, but just other secondary buyers versus trying to sell off and kind of like prune the portfolio and say like,
well, in the end of the day, look, I think, the fund selling to funds, you're just going to take some massive discount on that shit, right? Because in the end of the day, like if someone's buying a fund from you, they're really only buying the winners and the rest is bullshit, right? So in an ideal world, they just carve out the pieces they want. Like I want this position and this position and this position because I care about these companies, or I have an infinity thesis on them. Like everyone has to have, I actually think the infinity thesis really matters in terms of how people are thinking about how big things can get and whether they matter or not in the world. And then everything else, it's like, it's basically worth zero, right? We were joking at our firm about starting write-off co, right? Because that's the other funny thing that happens, right? Is you just kind of give up on positions and you sell them for $1 to take the tax advantage, right, on it. Every once in a while, the hilarious part is you sell something for $1 because you give up on it, and it turns out being worth something, right? So like, there's a whole business.
We love a comeback story.
hoovering up, irrelevant positions. But
Yeah.
I don't know. Does it happen? Yes. Do GPs sell piece of the GP? Yes, but that's complicated because the reality is at least the public market only really values the fees,
Yeah.
right? Which means so it's basically I've been having trouble because I wrote this 2023 thing that I was pretty proud of and I think was honestly pretty accurate about what was going on. Understandably, it's been 2 years. I wanted to update it and be like, well, where are we now? And there are things I think I got mostly right. There are things that I think are wrong. But I think that the real story is end of factory model. The factory's over. What the yada 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 on it is we're now, I think, entering this period where you don't even think about it as one integrated capital system. They're just different parallel universes. Everything in the world is regionalizing and fractionalizing. This is happening with globalization. We're having a deglobalization moment. This is happening with all sorts of things. I think it's happening with capital too. There are just literally distinct ecosystems and people play in multiple of them, right? But they have their own valuation logics, et cetera. And then I think the way people value companies as a result has changed. What you should be looking for has changed. The types of CEOs you want to back has changed. It's just a new world.
Did you dabble much internationally? This was a very 2021, 2022 thing with funds thinking that, they'd win a deal and 10,000 miles away. And then in hindsight, it's you have to think why did you win this deal? Why didn't, why are you, so lucky to have the opportunity to back this company? And then a lot of them just, are derivative
we've always invested in Israel when it made sense. I think the U.S.-Israel relationship is strong. I think there's a lot of good technology. There's a lot of reasons that makes sense. And so that's always been a thing we've done. We know it well enough to be confident in investing there. I think that the thing for us historically is, yes, in a Zoom world, you'll take the meeting in Europe, right? Because it's interesting and no one's accounting for your time as a venture capitalist. So if you're interested in something in Europe and they really want to talk, sure, you'll do it. But we're so lazy, right? That I don't want to deal with there's always an exception. We have done a handful of deals that are kind of outside the wheelhouse, but it's but I kind of believe that there's really something to, be New York, be San Francisco focused, pick a few geos, understand them, understand how they fit into the global capital world, et cetera. So no, we didn't get drawn into too much Europe.
What is your interpretation of the rumor around OpenAI potentially buying Windsurf for $3 billion? It's not an AI cherry on top business. It's a wrapper. Is it bull market for wrappers now? Are we going to see tons more acquisitions?
Yeah, Slow is going to FOMO into a bunch of wrapper.
Yeah, FOMO into every wrapper because they're just going to get hoovered up. I mean, my take was maybe, OpenAI buys one, then Anthropic needs one, then Amazon needs one, then Google needs one. And all of a sudden you have 7 unicorns getting bought. Everyone's making money. Everyone's generationally wealthy. That's the good ending, right?
I really am pretty cynical / don't think that we're going to see a lot of acqui-hire AI type stuff in this era. I think there's a few reasons that. One is what are you really buying, right? In some of these things, are you buying talent? That is not unreasonable, but and we've seen that. We've seen people effectively quote unquote buy companies that are literally just for the one person they want to pay $200 million to because they really think they're special because they need an exit. Look, some people are going to get massively overcomped. That will happen. I don't think it's an investment thesis. It is what it is. And I think it won't happen that much, but we'll see. I think there's going to be, are you buying technology? It's the thing about AI and a lot of where we're going is why, right? Software is getting commoditized. What is it? If you're buying technology, you got to be buying some really important technology, right? And I think that's the third thing you in theory can buy is just distribution, right? Which is if someone really has, for whatever reason, got their hooks into a few key contracts or they have a tail, fine, you buy distribution and that can be worth something. But look, honestly, it just seems all very squirrely to me at this moment. The thing I'd say in venture capital is there will be random walks. Some random stuff will happen, right? And I think you can't get too, twisted around that. You certainly shouldn't be chasing random walk. But no, I don't personally see it. And if anything, I'd say look, I was part of this. My first company was acquired by Facebook in the era of acqui-hires, right? And I think and I say this with some humility, but also perspective, is I think when you go back and look at like what was really bought there and was that a good use of capital by most of the acqui-hiring companies, I think the answer is probably not. You know, like that era is kind of over. People aren't that special. You know, the big companies, just because they have such incredible access to capital and distribution at this point, they can kind of just build whatever they need anyway, right? So anything that does happen will be highly bespoke as opposed to like some industry-wide trend, is my personal view.
How do you think right now about the dynamic between 30 to 50 million dollar early stage funds versus 30 plus billion-dollar AUM funds? In some ways, they the tiny upstart funds benefit from these big platform funds coming in and sort of marking up deals, right? The returns look good, but
maybe I just think they're two completely different business models, right? Like I think is the thing. This goes back to my poll about like regionalization and fragmentation of what capital even is, right? If you're running a $50 billion venture fund, you can't possibly be deploying that well early, right? And actually, you're paid to move gross dollars. The problem you're solving for LPs is you have some massive fucking LPs. They're like, I want exposure to private markets. It's really hard for me to go find how to do that. I would love you to deploy as much capital as possible. And like effectively the way you get paid is on fees. You're not getting paid on carry. Like it's, if you have a $50 billion fund, making 3x on that, so you're making money on carry, is like extremely difficult to impossible. Like the numbers just don't add up. You're getting paid to deploy. And that means your business model is attracting more capital. You have to return enough to justify it, right? But like you're not actually shooting for maximum DPI or actual returns. You're just shooting for that. And by the way, just to go a step further,
I just see this all the time where I have friends with funds that are maybe sub $50 million funds, and they're investing into like, even if the big platforms just periodically dipping down into seed when they have really like the founder or whatever, and then suddenly the round is like 6 on 40, and then just the like tiny fund, and then the tiny fund is like you could get a bunch of bangers, and you just do the math and you realize like they're not going to be making DPI either, and they're not getting management fees.
The late stage, what happened after in 2023 era, which I wrote about then, is like the late stage capital allocators who again are paid fees to deploy gross. They're weight deployers. They're mass capital deployers. They couldn't deploy. So a bunch of their junior people in particular, like, well, I need to do something to justify my paycheck. So they started dipping into seed, right? Because like they're bored, right? And they're like, we can't deploy big checks, so we might as well deploy small ones. And by the way, no one cares, right? Like it's such small amounts of money, it's irrelevant either way. That completely messed up the seed markets because it got super undisciplined, right? And like it did, because it's candidly, we do the same thing at Slow to like the angel market, right? Whereas it's a recursive problem. Like we will write $100,000 checks off a meeting because it's kind of irrelevant to us and it's just relationship building and like whatever. But there's some poor angel who's out there trying to price it properly and we don't care, and then we fuck it up for them. So like it's a recursive problem. That did happen. I think mostly, honestly, the late stage guys with AI have a narrative where they can put billions of dollars to work and do their actual jobs. So they've mostly pulled out of fucking up the early stage markets because they have better things to do with their time. That's actually what they get paid for, right? And just to make a finer point on that, a lot of these late stage public platforms, they really are like setting themselves up to go public. Here's the thing about that. When they go public, the actual way the public markets value these funds has absolutely nothing to do with returns. It is 100% the fee base, right? And so their structure and their incentive structure is 1000% about earning fees and just making enough returns to justify the fees they charge and raise more money. Like that's what they do. Then there's the early stage market. Here's the thing about those $50 million funds, right? Ultimately, you gotta eat. You got to actually deliver DPI, not just marks, right? And so marks are nice, like they're fine, but I think what we're going to find in a lot of ways is the gulf between I have on paper made a bunch of money or these deals look good versus like, oh no, I actually returned capital. I like made you money. You should give me more money, and I made myself money doing it. That's a pretty big gulf. And I think what we're going to find is that the market, most of those funds are going away because they don't have that and they're not going to. B, there could be a world where late stage funds start saying, okay, at some discount to the last round, I'll buy out these seed funds effectively and give them some DPI, et cetera. But then the problem for the seed funds is that mark they were using to be like, look how smart I am. That's not what they're getting paid, right? That's that's like the high watermark. Some investor invested later for primary. And when you come around and say, hey, by the way, would you like to buy my shares? And they're like, well, we'll take more. It'll lower our average cost base. They're not paying what they paid for the primary, right?
And then they're looking at their portfolio and they're like, I need to do this for 80% of my bets, basically, in order to like actually.
Yeah. So
and then it's like,
that's right.
Yeah. And so look, I mean, the upshot, the really simple way to think about it is like, if you're an early stage investor, you have to make money. Like that is actually what you are paid for. And people are saying, hey, I'm going to allocate a small amount of money to you. By the way, it's not efficient, right? Because if you're even a medium-sized LP, someone's running a $50 million fund, what are you going to give them? Like a few million bucks? Yeah. You don't care unless they make you a shit ton of money, right? Yeah. And so like, if you make them a shit ton of money, you're doing your job, you get to keep playing. If you don't, forget it. And that's just in a completely different game than what it means to be a late stage capital allocator in the private markets.
Yeah, I have kind of a random topic, but there's 2 early stage kind of publicity stunts going on this week. One is by Roy Lee. He launched Cluey, cheat on everything. I'm not sure if you saw this, but it was very controversial. And he's kind of like a troll, almost like a Nathan Fielder type, really kicking the bear. And then there's also this artisan company announcing their $25 million Series A with a billboard on the one.
I love billboards, as you know.
Yeah, we love billboards here.
Billboard
We're
guy.
sponsored by AdQuick. We love billboards. But the positive take on this is that, hey, they're breaking through, they're getting attention. Attention's valuable, distribution's important. The counter to that is, should they even need to do that? Shouldn't they just be heads down building? Where do you sit on that continuum?
I guess the question I would ask is what is the track record of companies that started with marketing stunts that ultimately were important or successful? Right. My sense is the track record off the top of my head is 0. Right.
Well, I mean, Facebook started with Hot or Not. That was very viral.
No, but
I'll give you an example.
Okay.
I'll give you an example.
Yeah.
So the challenge with going super viral early, and I had this with Party Round, is that people get a fixed idea. A lot of people get a very fixed idea of what your business does.
Yep.
And then you run into this like product marketing challenge, which, people are aware of your business, but they're aware of it for something that you may not even do anymore. And that's why I was talking with Cluey founder yesterday of like, you need to be committed to like iterating and basically burning the whole brand down, because you might find in 2 months that the real opportunity is something else.
Yeah.
I think that's a really good point. And like, I'll do a step further, which is in my experience, really successful things, you actually want fairly high barriers to entry so that the people who show up as your early customers are like deeply in need of it and true believers, right? Because if they're deeply in need of it, they're going to put up with a lot of crap to get what it is you're offering out of it, because because they really care. Like they showed up first and they like have a real stake in it. And then they become true believers in that cult that advocates. I think if you have too much attention too quickly from a not fervent enough audience, you get distracted. You have to deal with a bunch of the wrong stuff. People are flighty. So I think there's this irony, which is like how you get your first 100,000, 10,000 people and the barriers to entry there are like, and I'll give you a kind of counterexample, which actually kind of is a marketing stunt if you get into it, which is quite by accident. Ikram and I kind of started this jelly meme coin, which blew way the hell up and went crazy, but was supposed to be like a component of this app, Jelly we've been working on. The app's super cool, but like the app was not ready.
Yeah.
Right? Like and what's been really interesting to watch is because the app wasn't ready, you got a bunch of people in, most of them bounced. They're like, this isn't ready, this is weird, whatever. But you did attract a kernel of like crazy true believers that are really engaged with it. And then it's kind of like a fire. Like you kind of blow on the coals of that, right? And you kind of keep iterating and working. So I guess that's a long-winded way of saying I think the history of companies that start with a marketing stunt and blow up big is pretty poor. There probably is a way to like be very inefficient and like blow up something big or say something, funnel out 99% of the noise, somehow find that kernel 1%, work with that 1% and like treat it like kind of the embers of a fire, right? And grow up. So that's kind of the mental model.
It's like how you handle it. Got it. Yeah,
last question. How cooked is Tesla?
I mean, look, I've been in the camp of like Tesla's a meme stock for a long time, right? And I think Tesla's a meme stock, right? And so
Yeah, you posted, maybe it was yesterday. No, it was this morning. If Elon can move Tesla stock up by 7.5% by saying he is stepping back from Doge against the backdrop of profits and revenue they just reported, then yes, he probably deserves the $56 billion difference as a pay package. That is what the market says his attention is worth. I thought that was pretty on the nose.
Yeah, look, Elon is the greatest marketer of our generation. He's the greatest capital raiser of our generation. You know, he is the greatest, I think, storyteller. I mean, there's a lot that he's really, really, really good at, right? And you know, I think he's the ultimate cult influencer in a lot of ways, right? And he's built a lot of cool companies doing that, but it is so belief driven. And I think this is kind of the thing where it's like, you know, what is Tesla worth from a DCF perspective? We talked about public markets and how you value these things. Not a fraction of what it's traded at, right? Mm-hmm. But it is absolutely, he is great at the infinity story, right? Mm-hmm. The infinity story is so big, and infinity, you know, plus 0 equals big number. Yeah. Everything's about the marginal buyer. And it's incredibly loved because retail investors want something to believe in. Like, they want something that can go to infinity. It's the same thing with the Mars thing. It's like, look, I find the whole Mars thing in SpaceX so frustrating. I love SpaceX. It's like, you know, I think it's an amazing company. Like, what they do is incredible, right? Mm-hmm. And there's a lot I love in the whole 9 yards. The Mars narrative is so frustrating because it's so disingenuous on one hand, right? Like, it's just like the predictions are out of control. Like, it doesn't make any sense from like a fundamentals perspective. But my God, people need something to believe in, mm-hmm. right?
Yeah,
and so
that's a good
believe
thing.
In something.
Well, I think Tesla's coming back. I think they're going to put a naturally aspirated V12 with a gated manual in a new car, and they're going to sell 700 million cars in a single quarter.
I would fucking love that. If Tesla did that, I would buy Tesla stock just because that would be awesome.
There we go. We cracked it. Boom. It's going to happen. You heard it here first. Thanks for stopping by, Sam. This was fantastic.
Great to see you, Sam.
We will talk to you.
Thanks for coming on.
Talk to you.